Okay, we're going to continue in talking about land investments. We focused on the land problem, and we calculated the net present value based on a per acre basis, and we determined that the land was profitable. We talked about the characteristics of farmland, the alternatives in controlling land use, including the ownership and rental and leasing agreements. We talked about the sources of land prices, and then we analyzed the profitability of the land as outlined on page 45 of your handout and calculated the net present value on a per acre basis. In today's lecture, we're going to look at the financial feasibility of the land investment, and then we're going to look at some of the sensitivity of the net present value and focus on the maximum bid price. And then we're going to add another dimension to the discussion where we actually talk about changes in the real value. Up till now, we've assumed that the real prices were constant, and we allowed any changes to be due to inflation. Now we're going to recognize in the real world, in fact, you can have real changes in prices and real changes in returns, and we'll show at least one process is if you think that that's going to be a systematic increase. We're now in chapter 12 on land. Also, the next chapter is 13 as we get into leasing non-real estate assets. As we continue the land investments, this is where we ended, where we calculated the four components of land: cost, after-tax net returns. We didn't have any depreciable assets on the land, so it was zero. And then we calculated the after-tax terminal value. We determined that the after-tax risk-adjusted nominal discount rate was 8.5%. So we took each of those components and discounted them back to zero, added them up, and determined that we had a net present value of $39.46. So from a profitability standpoint, then we can say that this is an acceptable investment in terms of its profitability. Okay, the next step, as you know, is to look at its financial feasibility. In other words, we're looking at this land investment to see if there's a potential liquidity problem. As we've discussed several times now, this may be a good investment from a profitability standpoint, but if we don't have the down payment, or if this has a cash deficit in early years, if we don't have the wherewithal to cover those deficits, then we're going to lose the land anyway, so it's best we not enter into that contract. If we look at page 45, it says that a bank will loan this Mr. Aggie Rich $400 per acre of land, and the land will be amortized over 15 years at 12% with annual payments. And of course, this farmer plans on selling the land in 3 years, so there'll be a balloon at the end of the third year. This statement is what we glean from the problem. The farmer is paying $500 an acre. The lender will lend $400 an acre at 12% over 15 years. We can use our calculators then to calculate the payment by putting the 15N, 12% I, a $400 present value, zeroing out the future value, and calculating the payment, this A, this annuity. And it comes out to be $58.73. Now remember, this is a per acre, and we're doing 200 acres, and we can make those adjustments, but to keep the digits on the screen easier, I'm just doing it on a per acre basis. So we see that the farmer borrows $400 an acre. So at that time zero, he has $400 coming in to help pay for that land. But he also has that obligation then for the next 3 years to pay the $58.73 per year that includes interest and principal. If we're looking at this third component, which is the tax savings that are due to interest, we know that we have to separate this total payment into its interest and principal components because only the interest is tax deductible, not the principal. And we also know that we can do that by using a loan amortization schedule. We start with a loan balance today of $400, which means we begin the first period at $400. the total payment we calculated previously at $58.73. The interest payment, we simply take the $400 and multiply it by the interest rate. 12% of the $400 is $48. The remainder then, the difference between the 58 and the interest of 48, is $10.73 that allows us then to pay down the principal. So at the end of the period, after we reduce the principal by the $10.73, we have an outstanding amount of $389.27, which then becomes the principal amount at the beginning of the second period. And we continue through that, basically separating out the interest in each period and the principal in each period. What we really want in this particular case is two things. But we want the tax savings, and we get the tax savings recognizing that this farmer's in a marginal tax rate of 15%, meaning that this farmer is not including the payroll taxes or self-employment taxes, just looking at the federal taxes. And we get that by multiplying this 15% times the interest payment. So in the first period, 15% of 48 is this 720. And then in the second period, 15%, 4671 is this 701. In the third period, you can see that 15% of the 4527 is the 679. Now I'm going to take these three numbers and I'm going to take this outstanding balance. Both of these are going to be lifted and transposed onto the third component and the fourth component. That fourth component is the outstanding loan amount at the end of the third year. And you can see that we have this 3679, which is the outstanding amount at the end of the third year, shows up as our fourth component. We take those numbers and we sum each of them up. So in the first time period 0, we have a cash outlay of 100. Time period 1, we have a negative cash flow of $15.83. Time period 2, we have a negative cash flow of $14. But in the end of the third year, we have 190, so we have a positive flow. So we have a series of negative cash flows and then a positive cash flow. So what can we say about that? Remember that we're dealing with 200 acres. So for this first time period 0, this $100 down payment per acre, if we have 200 acres, what that means is that even before we can buy this land, you're going to have $20,000 at hand in liquid assets, cash or near cash assets, to be able to even buy this land for the down payment. Next, you can see that we have $15.83 deficit in that first year. We have 200 acres. We're going to have a total cash deficit of $3,166 in the first year, and similarly $2,848 in the second year. Now in agriculture, that's probably not a lot relative to the total revenue that's generated from a typical farm. That's not a large amount, so it may not be a problem. You're going to have to look at your projected cash flows to see if you've got a projected surpluses from other parts of your business. Okay, now is this problem unique where we had a potential liquidity problem, or is this a very typical of real estate investments? And I'm going to show you that it's very typical of real estate investments and try to explain why. And it has to do with this financing gap with land or real estate purchases. And this financing gap, it isn't just with farmland, it is any real estate purchase where you are buying an investment like real estate that has a long-term income stream that comes from it. The reason that we see this financing gap or this potential liquidity problem is that the loan payment includes a real return and an inflation premium. Remember, we said that the nominal rate is equal to the real rate plus the inflation rate plus their interaction terms. When you borrow money from the bank recognizes that you're going to be paying off that loan in cheaper dollars in the future. because the payment's constant, which means that when you pay off that $800 a monthly payment on your house 10 years from now, that buys less apples 10 years from now than it does today. They recognize that, and that's why they have a inflationary premium in the rate. So you immediately, when you take out a loan, you have this inflation premium built into your loan payment. However, if you're dealing with agricultural land and returns to that land, the money that you get that particular year, there is no inflation premium embedded in that. Okay, you're dealing with real dollars, real prices. But you might expect that over time that you might see those prices keep up with inflation. Now in agriculture, you know that hasn't happened very much. It means that the nominal prices have stayed the same, which means their real prices have actually been declining. With the loan payment that naturally has a inflationary premium built into it, we have a returns to land that does not have this inflationary premium. That's where we see this gap. But we expect the returns to land to increase over time and for that gap to disappear. Graphically, we can visualize this financing gap by this chart where we have the vertical axis representing the dollar amounts of the payments or net returns, and the horizontal axis representing time. If you look first at the net returns, you see that over time you expect the net returns to go up in response to inflation. If you're in an inflationary environment, you'd expect that the returns or profits or revenues are going to increase over time. On the other hand, the yellow line represents the loan payment, which is on a fully amortized loan is constant. So it's represented as a flat line. And you can see that over a period of time, in this particular case, in around 8 or 9 years, that cash deficit disappears. You may look at that graph and say, so what? It has some implications for you, particularly if you have any visions of being in production agriculture and you want to go out and buy land. What's the implication? How do young farmers that don't have deep pockets from inheritances cover those deficits? Their wives get jobs, and who else? They themselves during the winter. That's one reality out there is that if you're young, you have to recognize that you have that gap. You're dealing with deficits that have to either be covered with outside income or inheritances or some other source or some very profitable other businesses. How does that affect somebody that purchases a house? When your parents first bought their house, many of them, including myself, were what they call house poor. It's because much of our incomes went to pay what? For the house payment. But what happened over time with a fixed payment? Well, the inflation or their productivity over time increased their income relative to their fixed house payment.